Okay, Rohit, I'm going to make you the presenter now. Stick around to hear and see Rohit Shrivastava, Twitter handle at India Charts, and here they are. Hi, Rohit.
Hi, Dale. Thank you for having me.
Oh, very, very nice to meet you. Thank you so much for coming in today.
Thank you so much. Love to be here.
All right, so why don't you tell us how you got involved in the trading business? Were you an engineer first?
No, I was a student of commerce and accounting, and then I did my management and finance, my MBA in finance.
Okay.
And while I was doing all that, before I did my MBA, I did work in the markets for several years. In fact, I started tracking the equity markets from 1990 onwards when I was still in college, so I was around 18, I think. And and at that point of time, I was simply tracking prices. I didn't know charting as a science was around, and once I came around that, then I started plotting charts manually. And software in India was not available in the early days, but once it became available, I became a user of Metastock, which I still use. And from 94 onwards, I started working professionally with the Wall Street Journal, which was a publication that covered equity markets. And later on, after I did my MBA in finance, I worked with portfolio managers, and I've been almost now 18 years with a broker that is Sher Khan Limited. And as you know, I actively write and blog since the year 2000 on mostly, initially it was Indian markets, but I kept writing about various markets, but I have now increased my exposure to currencies and commodities since 2012, where equities became extremely fractured, even in India.
All right. So you have, I see your slide or setup, what you have for an alternate scenario in Euro. So would this imply that if we are going to get a rally up towards, it looks like B is up around 121.5 or so, does it mean we have to have a full-blown retest of support levels at 115 for that to happen?
Okay, so this is my alternate scenario and not my preferred. So I'll just take you through a series of charts on the dollar and euro, which would probably highlight my overall view on it, because I think the dollar index itself is largely made up of the euro, and therefore it gives us the big picture. And of course, we have much more historical data on it. So one of the first things that came out glaringly to me in my study a couple of years back in trying to understand whether the dollar bull market that we were in would continue much longer, or whether it would come to a screeching halt because sentiment had reached an extreme. You found almost over 95% people bullish on the dollar in late 2016. And that got me to look at this cycle wherein the dollar index has followed a typical cycle of being in a bear market for around 7 years and in a bull market for around 9 years, a couple of times since the 1980s. And so that's what I plotted here. And once I did that, so my understanding was to look for the end point of this current cycle that we are in, whether it would complete an ABC structure or not. And that's where I think most statisticians have debated whether there's one more leg up left or one more leg is not left. So I've concluded that this move is complete in terms of its 9-year cycle. It's A, B, and C. And we've started what should be a 7-year-long bear market for the dollar. So we are essentially in the initial waves of that bear market, which could go far, far lower.
Okay.
The second thing is
interesting that numbers 7 and 9, they're both kind of numbers of completion. Even 7 years of plenty, 7 years of naught, and 9 is a combination of 3 threes. So interesting numbers. Do you look at significant numbers, or this is just what your research ended up showing you, and that's the way you believe the dollar cycles work?
That's right. My research just ended up showing this to me. I did not choose the numbers in particular.
Right.
So I simply took the year in which the high or low was made and found that it was repeating pretty consistently for this time period.
Okay. It doesn't tell you magnitude, though. It just tells you, have you measured, I mean, all the bear markets look to have been very substantial, right? As far as magnitude of the moves, the one in, the late 80s and the one in early 2000, almost looks like there's bigger downside moves than recoveries. Does that tell you anything?
Well, visually on a logarithmic scale chart, as we're looking at this, it actually looks like while the declines are very sharp in magnitude, they might, and if I say magnitude in percentage terms, it might actually appear like the entire pattern is contracting. So a lot of people started to consider that this was some form of an ending pattern. Okay, something like this. And so it looked like a contracting pattern, and when it blew down there into 2008, it looked like this was a bottom from where you'd rally, break out, maybe have a significant bull market in the dollar. I'm sure some people still have that opinion. But when I look at it, I sometimes do this. I simply invert the chart and I say, well, this can also be a triangle that is bullish in nature if you get a failure, which is prices cannot really sustain above the 90 mark. So that becomes important from a long-term perspective, that this trend can change, and simply perpetually pushing something into a bull or a bear market might not be the right approach. So that's where I wanted to look at the internal structure. And so when I move to momentum and the internal wave structure, so I combine all the tools from technicals and Elliott wave analysis together to get a complete picture. So I'm just running down the momentum. Now this is the momentum on the quarterly chart, which has been in sell mode for most of the last 4 to 5 quarters. The RSI indicator here itself has not yet reached a deeply oversold situation. So my sense is this cycle is not complete. Also the momentum, which is basically your rate, it's a weighted average rate of change, similar to the KSP, is not yet below the zero line. Okay, and so I feel that cycle is probably not complete at the quarterly degree. On the monthly charts, while we have rallied quite a bit, we have stalled exactly at this previous swing high close to the 94.95 mark. And we've also stopped at what is the 20-month average, which is also at 94.95. And this also coincides with a 38% plus retracement for this entire decline.
So you have a great line in the sand for two different technical reasons where you have confluence there. What would you say if we had closes above 95?
Exactly, and that is why I had that alternate scenario, which was right in the beginning. My sense is that this rise is a three-wave advance which is complete, and most probably wave 2 is done, and we should start the third wave down for the dollar and probably up for the euro. But I would keep it as an alternate that if we do manage to develop a situation where we can get past 95, then probably we would head to 98 or 100 in a larger retracement of this entire decline before the third wave down can start. But right now there isn't enough evidence for it to happen right away. So the chances in the short term are that we are most likely to dip in the dollar first, because you've already completed, like I said, a three-wave advance, and you've already got extreme readings in sentiment, which were just last week at around 94% bullish on the DSI, which gives me a sense that we would be at the end of this near-term move. And so we're looking at a dip, and if that dip ends up being impulsive in nature, then I would expect it to continue in the larger third wave down. Only if the dip follows and ends up being a corrective pattern would we consider that you can get that move up to 98, 100 in the dollar again.
Could you go to 92 first and then above 95? Your last slide, I'm curious what the dotted red line represents on the slide you had previous. Yeah, that dotted line.
Yeah, so this dotted line is the 20 period average.
Okay.
So in this case, this is the weekly chart. So I'm looking at the 20-week average.
All right.
Okay, so definitely it's possible that we dip to the 20-week average, and if we do find support there, and if that dip is a three-wave decline, then we should consider the possibility that we would go to 98, 100 before you come back.
Okay, great looks. Okay,
so on the
so
daily chart, we've been developing some kind of a triangular pattern. We
right.
could have considered that this triangular pattern ended at the high that we made here almost 2 weeks back at 95.5.
Yeah.
But this decline that we saw in early July does not appear to be 5 waves. It appears to be 3 waves, which is why my sense is that probably this wedging pattern is not yet complete, and we can still make an attempt at 95 at the upper yellow line in the very, very near term.
Okay, so one more push up to shake out the 95.5 bears.
That's right.
Okay.
So with that, I move to the euro chart and the wave structure that I've considered here. I've considered that the entire move from 2001 to 2007-8 was an impulsive 5-wave advance, and since then we've completed waves A, B, and a 5-wave decline into wave C. A lot of debate occurs around this area 2014-15 as to whether the fifth is complete or you've still done 4 or 5. Now in case of the euro, you overlap, so it's no more possible to say that the fourth is still in development. And my sense is that the fourth wave here was a triangle, which is why it probably got overlooked, or it can also be a diamond triangle pattern, which is more a classical pattern which few observe.
So then you get a terminal thrust out of it, and that's it. So,
that's right.
Okay, so you had your terminal thrust at 103. You're counting the rally from 103 to 126 as 1, and now we're in 2, which implies a 3 is coming.
That's right.
Okay. All right. So go ahead.
So this is my primary count. Like I said, that we are in wave 2. Most probably A, B, and C is complete, and we will of course look at the next moves up. If they are impulsive or not, to really consider this alternate count that I started with.
Mm-hmm. Okay. So your business model is a subscription service?
That's right. I do a mix of writing a lot of free posts for my readers, which get published on my website and get sent out to my mailing list. And then I do write on a daily basis on all markets, global markets, usually in morning India time, and then I cover stocks and the index in the evening time. So typically sending out 2 emails, but I write on a real-time basis, so they keep getting published as and when I observe changes in the market trend. And so people who want those daily updates, they would subscribe to my services.
Okay. So besides the dollar and euro, was there any other instrument you wanted to share with us today?
Okay, one chart that I will look at, since we were discussing the US indices, and that is of the NYSE composite index.
Yeah, and it's a lot different picture than the other ones, isn't it?
Exactly, which is why I looked at it, because when we look at the S&P, it tends to be relatively complex. And at the same time that the Dow is also lagging behind the S&P, I found that the NYSE composite tends to give a much clearer picture, at least this far, that the entire pattern from February to date looks like a triangular pattern, which means that the top end, which means we are in wave E, probably almost complete. The top end of this triangle is at around 12,850. And as long as we don't get past that, most probably we should be topping in this zone and starting wave C on the way down.
Okay. All right. And that's going to be, you looking for equality or a fib extension of that first A wave down?
That's right. We would always start by looking for equality.
Okay.
But I've often seen that when you have a wave B occur after a long-term top, then wave C tends to be extended. So I think we need to be open to the idea that it's an extended move, especially if this does mark the end of a fifth wave for the longer term progression of the entire rise that we've seen in the NYSE. So if I do consider that this is 1, 2, 3, 4, and 5, and the fifth wave is complete, then most probable chances are that wave C down would not end at equality and would end up being extended.
Would that be the sign that there's more confirmation, it's more significant of a high? If you get, say, 1.618, would that be confirmation that this is not corrective anymore?
Yes, that would be a very, very meaningful indication that this is not a corrective decline.
Okay, I learned something from you today. All right, so an Elliotician's going to look at a fib extension and the degree of it to give him a market message of whether or not it's corrective or impulsive. 1.618 is more impulsive than equality normally, right?
That's right.
Okay.
And it's pretty amazing that this kind of pattern has already developed in the Hang Seng, which is the Hong Kong market. You already have a triangle, wave B and wave C. And we haven't achieved equality there as well. If we actually look for the lower end of the channel, then we haven't touched that point. And so far, we've come pretty close to it. And so that's also an interesting watch as to whether it extends or not. So which is why I've marked C, and I've also written 1 and 2 in case an extension develops, which would, as we discussed, indicate that a major top is in place.
Okay, is that one of the weakest indexes? I know the Shanghai has broken down as well a few weeks ago and looks to be suffering with all this trade dispute.
That's right. The Chinese index, of course, has been the weakest, but and it's taken most of, I think, the Asian market. So if you look, whether we look at Jakarta, Kuala Lumpur, most Asian markets have performed extremely poorly. The surprise within then the Asian markets is the Indian market itself, which I track on a daily basis, the NIFTY. The NIFTY itself has actually not declined that much, and so that would be the next interesting chart to actually discuss.
Okay, we have people that ask about the NIFTY almost every day, so it's good that you're on because they're probably countrymen of yours, so would love to see your look there. And then I want to wrap it. I have one question for you after this chart.
Right. So what I'm going to do is start with this comparative chart. You can see two on this. One is the mid-cap index and one is the NIFTY. What has been happening since the top that we saw in the US market and in Indian markets, they more or less occurred at the same time in the last week of January.
Right.
And the broader market in India, the mid-cap indices and the small-cap indices are already down almost 20%. In fact, today itself, this is an updated chart. We've broken last week's low in one swing. But on the other hand, the NIFTY has remained elevated and was very, very close to its previous highs, almost making what you may say is a double top.
Okay, so is the NIFTY comparable to the Dow and the mid caps comparable to, say, the Russell or NASDAQ?
That's right. That's right. You could say that. Though the mid cap index is not made up of more than 200 or 300 stocks, so it's not a very large basket.
Okay.
The NIFTY itself is just 50 stocks. But they do differ in the capitalization. So the mid-cap stocks are, of course, of a lower capitalization, and the NIFTY is of only the large-cap stocks.
Okay, I wanted to ask you about one thing I saw on your website, and that's you write about the Indian economic winter. And I'm curious if this economic winter started when Modi made certain rupee denominations illegal and went through that period where people couldn't use their cash for a period of time and still can't. So explain to us what kind of weather you get economically during economic winter, because I think a lot of the world isn't even, that's not even on the back of their minds right now, with the market being at new highs and real estate values here in the States being lofty, and great employment numbers. So okay, so you use Kondratiev. All right, so we're just beginning this winter cycle in your view.
That's right. In terms of the Indian economy, the winter has been developing, I think, since 2010. So I'll explain that. I essentially use the work of from the long wave group, and when I studied Ian Gordon's work, I think he put in a lot of detail in terms of how each of these cycles worked for the US in terms of interest rates, commodity prices, and equity prices. And so I took all of that and extrapolated it onto the Indian cycle. Now, of course, this is a backdated chart. Few people have seen. It comes from another highly rated analyst, much more older than me, Vivek Patel, who backdated all the way till the 30s that the data was available from the British Advisory and then the RBI index. And when you look at this, you actually see the progression as waves 1, 2, 3, 4, and 5. Now, people who don't have this back data usually think that waves 1 and 2 are over here, when this is the longest advance that Indian economy had, which is what they miss out on.
Okay.
So what has happened is after the boom that we had in 2004, and usually this is, so I've marked over here that this is the economic summer. Now, an economic summer occurs at the end on the back of a lot of high interest rates and inflation, like you saw in the US in the 70s into the early 80s. Okay, and then you raised interest rates and had control over inflation and interest rates for the next 2 decades. We had a similar situation, but almost 15 years later. India, after 1990 to 94, had double-digit inflation and double-digit interest rates. We have seen 15 to 20% interest rates at that point of time. A lot of people are not aware of that. And then we eventually got that situation under control by 2001, which is where our bottom bull market started on the back of low interest rates. And this boom has then since been going on. Now, India's corporate debt to GDP was extremely low at the start of that cycle, but as the government did not expand its balance sheets, the corporate sector kept on borrowing and reached an extreme. So since 2010, most companies that had high debt equity ratios have essentially not performed. They're almost down 50 to 80% since 2010 itself. So from a pure economic and stock performance point of view, the winter cycle starts from 2010, but what has happened is, as you see on this chart, I marked 5, the fifth wave has constructed itself into an ending diagonal. So now I've moved on to the NIFTY 500 index to show you what has been going on. So the fifth wave during this entire time period, at the start of this period, mostly we did not believe that India had a problem of debt. Over the last 3 to 4 years since Raghuram Rajan was in, he pushed banks to start reporting their non-performing assets, which they were not doing in the prior period. And it now has become apparent to most that we have an NPA problem where, the banks, at least the public sector ones, have NPAs going to 10 to 15% of their, loans. So that's become a big problem that we are dealing with, which is the clear signature of that we are in the winter cycle, and we need to deal with those debt problems, which is why the corporate sector, despite high rates of GDP growth that we are reporting, is unable to report a high rate of earnings growth. Even in the last quarter, we've actually seen growth not come in on the earnings side simply because of high interest costs. So this is the situation we are in. My sense is that the NIFTY is essentially at the end of this fifth wave. We most probably completed it in Jan for the mid and small cap indices, and are probably completing it now for the NIFTY and the Sensex in the current week.
So any studies similar to what you did with the dollar, where you have, this is like the 9th year in the U.S. of a bull market, and then do you have like 7 years of a bear, or do you have any kind of time projections? How long this winter? When are we going to be able to take our boots and put our shovels away and come out and plant roses? Buddy?
The typical bear market in India historically has not been more than 2 years. The deepest one that we saw was back here, which was around 18 months. We've seen a maximum 2-year bear market once in the 1980s. So I wouldn't really project beyond that at this point of time. I would say if we peak, say in 2018, then probably the worst is over by 2020 for the Indian market as we unwind through this period.
Okay, can the economic winter go on longer than the financial market winter? Is that what you're saying?
Definitely it does. Definitely that's what happens. It's obvious from the study of the US market itself. From 1929 to 1932, you had the Dow bottom, but if you do an economic study, some would say that the winter cycle ended only by 1940. So the stock markets tend to extend on both sides, the upside and the downside. It's possible that, and my sense is that the stock market would probably bottom before the economic cycle, which is normal. More often than not, as EWS study itself shows that when you have a wave too low, it often occurs on weaker sentiment or worse economic data than the starting point of the next move up in equity prices. So yes, by the time we probably hit wave 2 of the next bull market for India, we'll probably be through the worst as far as the economic cycle is concerned.
What a great interview, Rohit. I'm so glad I reached out to you on Twitter. I encourage everyone who's watching us live to go to your website, www.indiacharts, and to follow you on Twitter. And I really do appreciate you giving us both the macro and the micro today, Rohit. Let's keep in touch, and excellent work in my view. You are now my trading warrior brother.
Thank you so much.
It was a pleasure. And thank you for sharing your wisdom. It was
a complete pleasure for me too. Thank you.
Thank you for sharing your pearls of wisdom with F.A.C.E today. That's it, everybody. Twitter handle is @IndiaCharts, plural, @IndiaCharts, Michael. All right, everyone. Enjoy the rest of your day. See everyone for Turnaround Tuesday. And remember, don't just count your pips, count your blessings. Adios. Enjoy the rest of your day. Thank you again, Rohit.
Thank you so much.